And any string we pull on in this conversation will be a derivative of that debt crisis, this massive amount of unsustainable, historically unrecognizable debt. And whether we're talking currencies or precious metals or stocks and bonds or central bank policies or the gold and silver price or the recession in our backyards, all of these things stem from debt.
Welcome to Discourse with Christian. I'm your host, Christian White, and today's guest is Matthew Piepenburg. Matthew is a partner at Von GREYERZ and author of Rig to Fail with deep experience in real assets, macroeconomics, and precious metals. He's one of the clearest voices on navigating today's distorted financial system. Matthew, thanks so much for being on the show today.
Thanks for having me, Christian. As always, I like talking about these topics, and I look forward to sharing thoughts with you on it. So I'm really, really glad to be here.
Absolutely. And likewise, would love to start off asking, as I do with all my guests, what's your current take on the global economy and financial markets?
Yeah, and my answer will be the same as it always is, and everything I write and talk about, really for the last 15 years, and certainly the last 5 when it talks about precious metals, is my global take is very historical more than just financial. And the historical reality is at 37 trillion in public debt and the global debt reaching 400 trillion, we're at an unprecedented debt levels. We're at an unprecedented debt crisis. And any string we pull on in this conversation will be a derivative of that debt crisis, this massive amount of unsustainable, historically unrecognizable debt. And whether we're talking currencies or precious metals or stocks and bonds or central bank policies or the gold and silver price or the recession in our backyards, all of these things stem from debt. So my macroeconomic conversation always starts with we have gotten to the point where the debt can no longer be can kicked indefinitely and where it can no longer be monetized by a central bank that literally mouse clicks money at the Eccles building to pay for that debt. And we are now at a turning point. And it's not gloom and doom, the end of America or the end of the world reserve currency or the end of the dollar, but we are very much going through what everyone from Ray Dalio to Stan Druckenmiller to Jeffrey Gundlach in LA, we all know that we're at a tipping point, a turning point, a seismic shift in the nature of global markets and the nature of U.S. hegemony. Again, not the end, but a change. If anything, because of these debt levels and because of the distrust and because of the geopolitics and because of the polarization in U.S. politics, I think we're at a very significant tipping point that's leading to a global disorder, but a new order, but a very dysfunctional new order, the ramifications of which are impossible to predict in every detail. But I will say it's going to be, and it already is, and it has been messy for a while. It's going to get messier because there is no instant solution for the debt crises and what they're doing to markets and currencies and what they're doing to trade. So it's really an historically fascinating time to be alive. Doesn't mean easy, but it is like 1971, a tipping point in the global financial order, all of it linked to debt and currencies, of which gold is a derivative conversation. But it's fascinating. The things that Egon and I have been writing about and thinking about, and others are not gloom and doom, but they're just based on the cycles of debt and the cycles of monetary policy. And we're at a point now where things are openly cracking and we're reaching desperate measures, whether it's in DC or the European central banks or the Bank of England or in China or Russia. So it is a fascinating time, Christian. It's a difficult time to navigate. I think if anyone's trying to make sense of it, whether it's politics, whether it's partisan politics or market views, bull or bear, whether it's optimist or pessimist, globalist or protectionist, you can't ignore the elephant in the room, which is debt levels, which have become simply irrational and unsustainable. And because those debt levels are going to cause ripple effects that we need to discuss. And it's an unprecedented time, but it's just another cycle in history of debt gone too far and currencies debased to pay for that debt and the consequences thereof. Yeah.
Gotcha. And as it relates to, global debt, liquidity, and overall systemic risk, my first question is, you said every crisis is a liquidity crisis. How does today's environment echo past collapses, and how is it fundamentally different from '08?
Yeah, these are great points. I mean, again, when you can look at the history of the US, or you could look at the history of global markets or the history of US markets. You go back from the 18th century to the Civil War in the 19th century, to the Great Depression in the 20th century, to the market swings we had in the last 40 to 50 years, whatever crisis you're looking at, whether it's pre or post Civil War, the crisis in the 1870s, whether it was obviously the Great Depression, whether it was Black Monday 1987, whether it was obviously the great financial crisis of 2008 or the COVID crisis in 2020 or what we're seeing today, whatever market you're looking at, I'm picking the US for simple reference, but whatever historical market crisis you look at, whatever the cause, whatever the backdrop, whatever the context, the ultimate issue was a lack of liquidity, a lack of money or a lack of credit to sustain a system that had gone over its skis in debt in some form. And the most obvious in the US Civil War, when we went off the gold standard, was because the Civil War was many horrible things, but first and foremost, it was very expensive. So we had to decouple and create a greenback to basically monetize the debt of the US Civil War. That was a desperate measure. And then we got back onto a gold standard and got on and off it over the years. But again, every market crisis is a liquidity crisis. And you don't have to go back centuries or the Civil War, post Civil War, the 1930s under FDR. You could look back, and we will talk about 2008 because that's a very important example. But you can look back just since 2019, the ignored crises that were all credit crises, which means a debt crisis, which means there's too much debt and not enough income, which means there's not enough liquidity. Every market crisis is a liquidity crisis, and think of liquidity as the grease necessary to keep a spoke moving or an engine moving. When that grease dries up, the engine breaks down, the markets break down. We saw so many hints and signs of our engine dying just in the last, frankly, 6 years. It started primarily for me in 2019 in the repo markets, which are wonky and crazy. It's intrabank lending, but they dried up. That was a big headline in September of 2019, forgotten understandably by most, but that was the first real sign of a credit crisis right in 2019. Fast forward 1 year later, 2020, obviously the context of the COVID hysteria taken too far and the measures taken therein. But we had in March of 2020 what they called a COVID induced crisis, but it was really a credit crisis. There was a problem in the bond markets that the COVID context took the blame for, but it was really already a period of tremendous illiquidity. And that saw itself play out in March of 2020. Fast forward 2 years from there, 2022, we had the worst nominal returns in US markets and bond and stock markets combined since 1871. That was also a credit crisis under the higher for longer Powell raising rates. I don't want to get into each silo into long discussion, but again, each of these examples was a credit crisis because there was too much debt, not enough liquidity. 2023, Signature Valley Bank, First Republic, right in your backyard in California. There was a quote unquote headline banking crisis, but again, underneath the headlines was a credit crisis and a liquidity crisis because rates had gone up, bond prices had gone down, the value of bank collateral had lost its value, banks didn't have liquidity. That was a liquidity crisis. You fast forward to 2025, what we just saw in the markets, that too was a lack of trust in US Treasuries, a lack of confidence in the future based on US debt, and the tariff reaction. Again, a credit crisis, a debt crisis, a liquidity crisis, which is still playing out. All I'm trying to say is you don't have to go back centuries or even a decade. You can go back just the last 6 years. We've had so many signs of this credit crisis. 2008, which was the great financial crisis, was certainly a liquidity crisis. Again, too much debt and bad assets, mortgage-backed securities, subprime mortgages packaged together, tranched together, and these asset-backed securities, which were labeled as AAA or AA credits, in other words, good credits, when in fact they were horrible credits. So there was a dishonesty in their packaging, a dishonesty in their distribution, and a dishonesty in their valuation. When those markets started to fall over, there wasn't enough liquidity or grease or income or incoming money to pay for the losses and to sustain those markets. So the Fed had to basically create QE and buy those mortgage-backed securities. So that was a classic liquidity crisis, isolated technically into a category of real estate risk or subprime mortgage risk. And when you're comparing 2008 to what we saw and what we're seeing now as we're heading into another type of credit crisis, what made 2008 like 2001, the dot-com bubble in California where I started, and certainly 2008, the great financial crisis, which was a real estate bubble, What makes today's everything bubble more, I think, compelling than 2008, which was a real estate related crisis and largely focused on US markets and West European G7 markets. China, Australia, other countries in Asia weren't as affected, but that was a real estate crisis, a subprime crisis, a credit crisis in 2008, the tech bubble in 2001. That too was a liquidity crisis from overvalued stocks tanking, not enough buyers, not enough money to support those markets under different rate policies. But what makes today different is it's not a tech crisis, it's not a real estate crisis, it's a debt crisis that affects almost every asset class. It explains every asset class, and it's not just linked to the U.S. or the G7 or the West and Europe. It's global. Uh, it goes from China to South America, stops over in Central America, certainly hits the U.S., Canada, and Mexico. Ironically, the country that's least in debt and the big powers is Russia, which is engaged in a major war. But what I'm saying is what is really uniquely compelling today is that there is overvaluation in just about every asset class because there's been so much printed trillions to sustain bond markets and to sustain credit markets. There's literally mouse click by central banks. There's so much debt that is behind the quote unquote growth of the European community or the West or certainly in the US, and not enough GDP or tax receipts. And this is no longer US or European, it's global. So the risks are now global. The ripple effects will be global. And when there's this much dysfunction and debt and credit risk globally, anything that threatens that credit create crisis, anything that pops that red balloon of credit will ripple effect into all areas and all geographies and all zip codes and all economies to some extent, greater or worse, which is why the tariff conversation now is so compelling and so debatable, but so threatening to an already very fragile system who has the facade of growth, whether that's in Europe or the US or even in China in many ways, has the facade of growth, but beneath that is just a ton of credit, which means a ton of debt. When that credit dries up or that debt defaults or that debt is threatened, things break very quickly. And nothing breaks a credit bubble faster than, this is boring, but rising rates or rising bond yields are the same thing. The yield on a 10-year treasury is the real cost of debt. It's not just the Fed funds rate. So when the yield on a major sovereign bond like the US 10-year starts to go up, that means the bond prices are going down because no one wants those bonds or trusts those bonds. As those yields go up, that means credit is under pressure. The cost of covering debt is getting higher. And most leveraged companies and countries like the US can't pay for that credit, can't pay for that debt, and things start to break down. And that is what we just saw in the last couple of weeks during the announcement of the tariffs. It's an unknown kind of secret. No one really noticed it. But right after Trump announced the tariffs, and we can get into the details of this, no one showed up at our U.S. Treasury auctions. Our U.S. Treasury wasn't considered a safe haven. They were not buying. Usually, a Treasury auction, it's the primary dealers and the central banks buy about 20% of our IOUs from Uncle Sam. After that tariff announcement, it was like 2% of the big banks and the central banks showed up. There was no buyers for this sacred cow, this US 10-year, this IOU from Uncle Sam. No one trusts it. There are a lot of reasons, though, they don't. Primarily because America's in a debt crisis. It's over its skis in debt issuer of an asset, an IOU that no one trusts because we weaponized that in 2022 against Russia, whatever you think of that war. This combination of a over indebted U.S. Treasury, an over indebted U.S. government, an over indebted U.S. dollar, with a weaponized dollar post 2022, and the world moving away from that dollar quantifiably, all of these things are happening simultaneously, and they're coming home to roost, which is why after that tariff was announced, within a couple of days, there was an about face. There was a change in policy. Again, we can get into the weeds on that, but all of these things suggest to me that we have a real problem in 2025, to answer your question, which is far more global, far more dangerous, far more debt measured than anything we saw in 2008. So the size of that red balloon of risk based on too much debt, too much credit, too much leverage is much bigger in 2025 than it was even in 2008. So whatever needle pops that red balloon, whether it's a tariff announcement, whether it's a geopolitical event, a black swan event, a known or unknown event, an assassination, a policy, a rate hike, whatever pops that balloon in 2025, is going to cause far greater momentum and stress than anything we saw in 2008. I'm not here to time what that will be or when that will come. In many ways, it's happening right in front of us, but the risks have never been higher. That's not gloom and doom, precious metal book selling or selling your book. That's history and math. If every crisis is a credit crisis or a debt crisis, if that's true, if you believe that premise, and history confirms it, then if we have the greatest global and national debt in the history of capital markets, or frankly, the history of the globe, if we have the greatest debt bubble, the greatest credit bubble, the greatest leverage bubble, and when and if it pops, won't we have one of the greatest financial stressors in capital market history? And that's what has so many people concerned, or at least that are paying attention. That isn't gloom and doom. That's understanding credit, debt, and history. So, long answer to a short question. This is a far more dangerous time than 2008 or the preparations leading up to 2008, because it's not related to just a particular sector or geography. It's not like the dot-com bubble where it's tech or real estate in 2008 or subprime. It's also larger in scope because the debt is global, and also because the asset classes are broader, that are overextended, overvalued, and overpriced. So I think it is a very different kind of lead up or cliff that we're walking towards in 2025 than anything we were walking towards in the autumn of 2008 or in the spring of 2000 or 2001 with the dot-com bubble. Again, that's not meant to be gloom and doom. It's not meant to be anti-stock or bond. It's just looking at the tea leaves and looking at the history and looking at the bond yields. Honestly, it's a very, very interesting time, and it's not safe. Doesn't mean it's the end of the world, but there's more risk than there is reward in risk assets. There's less rather than more love for U.S. bonds, and there's less trust in that, and there's more overvaluation and a much more narrower stock market 2025 than even during the dot-com bubble or the 2008 bubble, because you're really talking about a market that's led by a handful of names, and where they go, the rest of the markets will go. That's too narrow. That's too risky. It's a very different time. I mean, there's 4 tech companies in your state of California that cover more than 10% of the tax receipts. That's not a sustainable model for a country, a state, or an economy. So again, very, very narrow markets, very overvalued, very debt driven, in the backdrop of the greatest debt bubble I have ever seen or studied, and we're living through it right now. So when that red balloon bumps into the wrong needle, things start to fall apart. The VIX shoots up to past 50, and we start having politicians promise miracle solutions. That's nothing new. And it's a very, very interesting time. Having lived through the dot-com bubble, profited from it, frankly, in the 2008 bubble, to see what we're going to right now, I'm not alone, is a very interesting time to be observing, and certainly a very, I think, opportunistic but scary time to be investing. And I think the more people understand that the bottom of every discussion is a debt crisis, and from that everything else can be understood. Once you understand debt, you understand what available choices are, what desperate policies are left, and what the ultimate ramifications are going to be. Most of the time, debt is covered or paid for or monetized at the expense of the dollar in your pocket, because governments will create more money supply. They'll add more water to your wine, so to speak. They'll literally mouse click more money into existence, and that is inherently inflationary. And everyone on Wall Street knows that the CPI scale of inflation is an absolute fiction. We have much higher costs of goods and services in the U.S. than the official CPI scale. And certainly, you in California and anyone watching this in the U.S. knows that it's much higher inflation than what's reported, whether it's tuition, whether it's cost of living, whether it's groceries, whether it's gasoline in California, whether it's medical care. So obviously you're getting taxed invisibly through a much higher inflation than is reported, at the same time that you're looking down the barrel of the biggest credit bubble in history and a market tipping on the edge of overvaluation. These are just very fascinating times.
As it relates to fascinating times, curious offhand as far as some of the conversations that you have with your clients
Mhm.
and others in your circle, kind of what's their response or sentiment? I mean, are they more or less in agreement? Or are they just, if you can kind of unpack that if you care to?
Yeah, of course. I mean, it's always good that you get great intel from your clients, just like they get good intel from their mentors or the service providers or their advisors. We have clients from 90 countries. Many of them are from the United States. most of our clients are very sophisticated, very successful, financially successful people, because the minimums at our particular company are quite high. For our vault in the Swiss Alps, which is the safest vault in the world, that's a $5 million minimum. For our other vaults in Singapore and Zurich, it's a 400,000, roughly a Swiss franc minimum. So these are people that have a serious, sophisticated understanding of gold and silver and a serious commitment to gold and silver, because they're talking large amounts of money. So they're not just doom and gloomers. They're not just whimsical in their understanding of gold and silver. But the real thing that they all have in common, as you and I discussed before we recorded, they understand money, they understand markets, but most importantly, they understand history. They're not looking at gold and silver as another asset like they do tech stocks or real estate or any other private equity or SPACs or credit pools. They understand and allocate to gold and silver because they understand history. History, without exception, shows that all governments, good or bad, democracies, oligarchies, monarchies, throughout history, eventually get to a point where their debt levels are too high to sustain through tax receipts or GDP or productivity. And when that happens, objectively, they debase their currency to cover their debts. And if you debase your currency, you need something with more purchasing power than your greenback, your dollar, your fiat paper money, which is backed by nothing. Throughout history, one of the best ways to protect against the debasement of your national currency when it's not backed by gold is to buy your own gold, to ensure your own money privately. If your central banks or governments won't do it, you buy your own precious metals, not to get rich because you bought gold at 1200 and now it's at 3400, but simply because you know it holds its value better than the paper dollars that are in your checking or savings account. And so the conversations we have are almost conversations where we're preaching to the choir. Most of our clients come to us from these different countries who already understand the message. Gold is not a get rich quick asset. It is a wealth preservation asset. Whether you have a million, a billion, or half a million, you want to protect whatever income or wealth that you measure in dollars or pesos or yuan or euros or Swiss francs. You don't want to measure your wealth just in that paper money. You want to measure it in something that holds its value over the centuries. It's not an exaggeration. It's not a pet rock. It simply holds its value better than fiat money. That's a fact. It's not a fable. They understand that. Of course, it's always great to see price appreciation if you bought gold at a low price and it rises. But when gold goes to 4,000, 5,000, or 10,000, it's nothing to gloat about, because the cost of a loaf of bread or a car tire or a pair of tennis shoes is going to go up exponentially. Gold just holds its value, and it rises in price because the purchasing power of your relative currency is going down in value. And all of our clients understand that first and foremost. They all do. And Egon von Greyerz, who founded our company over 25 years ago, was a banker out of Switzerland, was the chairman of a FTSE 100 company, very conscious of stock markets, very conscious of Swiss banking, international banking. All of the partners at Von Greyerz, most of us except for one, worked in big banks. We're all very familiar with banking. We're all very familiar with hedge funds and alternative investments and speculation in the markets. But what Egon saw really way ahead of most is certainly in the precious metal space. He didn't choose gold because he thought it was just going to go up in price. He understand gold as a former, equities guy, as a former banker. He understand gold as a far better store of value than a Swiss franc or a dollar or a euro, or at that time a Deutschmark. In other words, he just understood that gold held its value, and however he measured his wealth, he knew it wouldn't be safe to measure it in a fiat paper money system. He happened to buy gold at $300. Now you fast forward to today, he's very modest. Gold has gone up tenfold since he bought it. And he bought lots of it. He's very modest about this, but he's like a value investor like Buffett. But he didn't do it in equities. He did it in precious metals. So he gets the double victory of seeing price appreciation. But more importantly, he bought an asset that holds its value infinitely more than a US dollar or a euro. And so he'll never say it out loud, but he's been a mentor to me and to all of us. And I've watched him for years, even when I was on Wall Street. That was just common sense to him. That was historical common sense. Because by 2000, he saw the posts writing on the wall of the dot-com bubble coming and the devaluation in tech and the measures that the central bank was taking to create the next bubble, which is real estate, which is low interest rates and printing money. He knew that historically meant one thing, that the paper value of fiat money is going to lose purchasing power. So I don't want to measure my millions, whatever my wealth is, in paper money. And so he bought gold at 300. Now it's well past 3,000. He's not gloating. He saw this, like many others, way ahead of the curve. He's certainly happy to see price appreciation, but more importantly, he's preserved the power of his paper money. He's preserved the power of his wealth and his family's wealth for generations. And again, it wasn't about getting rich quick. It was about understanding that paper money always loses value in a debt-soaked backdrop like the US, even though US, the great US, is over its skis in debt. And he understood that since 1971, when the US went off the gold standard, that the purchasing power of a US dollar has lost greater than 99% when measured against a milligram of gold. That should not be a gold bug apology or propaganda or selling or a trick. That's an understanding that paper money is not the truest value of wealth when a country's in debt and desperate. And Egon saw that way back in 2000. He certainly recognized it in the 70s when it was happening. And he understood history, whether you go to Yugoslavia in the 90s, obviously Weimar Germany in the 30s, or France in the 18th century in the 1780s and 90s, or John Law in 1720. If you understand history, countries have been doing this for years, for centuries, going over their skis in debt, probably because of wars or trying to get reelected and promising more than they could deliver. They debase their currency. It goes back to ancient Rome and the denarius. They debase their currency, and then the currency loses value. You have hyperinflation or inflation that causes a huge pain to the man on the street, and their paper becomes more and more useless. And those that had gold tend to survive and strive and thrive much better. So he was just insuring himself against dying paper money. And he knew that 25 years ago, 30 years ago. And our clients have known it as well. It's not a hard sell. It's not about all you do is buy gold. It's just like you have health insurance, car insurance, life insurance. You need currency insurance for countries that ruin their currency. So you buy physical gold. The Swiss have been doing this for generations. They've seen empires rise and fall. They've seen financial systems come and go. So it's not unusual to have 10 to 20% of your net worth in physical gold in a private vault outside of a banking system that you don't and cannot fully trust. Again, very common sense to most people in Europe or certainly in Switzerland and the rest of the world. Harder for most Americans to see because they're understandably convinced that nothing can go wrong in America, or that the Fed has their back, or that some expert somewhere knows what they're doing. But no, our clients understand political human nature, economic desperation, cycles of debt, debasement of currency, and the role that gold plays in all of those cycles. And again, we've had a Dutch empire, we've had the Habsburg Spanish Empire, we had the British Empire, um, we 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 have the U.S. empire today. All of those empires, whether it was the British, the Dutch, or the Spanish, or the American, the British didn't disappear when their empire ended. The Dutch didn't disappear, and the Spanish didn't disappear, but their hegemony and supremacy did. Just like in the UK, there was a time when the sun never set on the British Empire, and now it does, because they got over their skis in debt, and they didn't have a solution, and they debased their currency, and they couldn't maintain their empire. It's hard for many Americans with the idea of Iwo Jima and the flag and the great iconic America that you and I both love, and will always love. It's still love, and we're still patriots. But it's hard to see that since those iconic days from Clark Gable to today, or saving the world from fascism with the Soviets, or saving the world from the Kaiser in the First War, these great American ideals, this great American country, since the 19 really 70s, but earlier, has gotten over its skis in debt. It's no longer the world's greatest creditor and manufacturer. It's now the world's greatest debtor and outsourcer of jobs, and we run on debt. That's not anti-American. That's actually being patriotic, to recognize that, to hold it accountable, and to protect yourself from a government that hasn't protected you by sound money policies. It's hard for Americans to realize it's got this slow frog boil of currency debasement and inflation and mismanagement at the Fed and mismanagement at the White House, left or right. All parties are guilty of promising more than they can deliver and paying for that with mouse-clicked money. It's very, very hard for most Americans to see that. They don't want to see it because it's painful. And politically, they don't want to take sides and blame any one party if they're against that or for that party. But it's agnostic to left or right or center. It's an American phenomena, especially post-Nixon, that we have been living on the borrowed wind and the rotten wind of debt paid for with money created out of nowhere at the central bank. And we've called that growth. We've even called it modern monetary theory. But again, going back to the 1700s or going back to ancient Rome or 19th century France, modern monetary theory is neither modern nor monetary nor a theory. It's been tried, tested, and failed over and over and over. It will fail again now. And the evidence that it's failing is literally all around us.
I take it very few policymakers or those in positions of power in Washington and perhaps other parts of the world and central banks are in even receptive to what you're dispensing to the audience and such.
Well, look, if I were, and I've written critically of Powell so many times, and it really, I've said the patient zero of this was Greenspan, and I'm not name dropping. I've sat across from Greenspan. I've talked to, I've listened to him. I've talked to Fed officials like Thomas Hernig, and there's some that I never met Martin or Volcker. There were good, uh, I think, fiscally disciplined central bank heads like Martin and Volcker. Powell is somewhat trapped, but Greenspan, Yellen, Powell, they're politicians first and foremost. And like any politician, you'll never hear them apologize or take accountability or admit they were wrong about anything. It's almost impossible. And if I were at the central bank, if I were the Fed chairman or chairwoman, of course I have to do what a coach would do or a combat leader would do is keep the troops or the players confident. You can't be negative, you can't be sour, you can't be pessimistic, and you certainly can't be gloomy if you're in charge of a central bank or an army or a team. And so it's in his nature and his role to try and be calm and carry on as much as possible. And like a politician, he has to use his words carefully, and he has to exude a narrative of confidence, a narrative of fiscal responsibility, a narrative that the Fed is really about inflation and unemployment, and that that's the role of the Fed. That's the narrative. If you look deeper into the history of the Fed, why it was created, when it was created, who created it. There's a great book, The Creature from Jekyll Island. It's a classic. It really reads like a Tom Clancy novel. But the Fed's real mandate, it's independent. It's not part of the three branches of government, but we all know it's incredibly embedded into Washington, D.C. If you go to Constitution Ave in Washington, D.C., and you look at the Federal Reserve, it's neither federal nor a reserve, and frankly, it's not constitutional. The Constitution gives Congress the power to levy, create money. We created this beast in 1913, so it is technically independent, but it's in substance a fourth branch of government. It's very, very powerful. It has the power to create money and it has the power to price money through interest rates. Those are two massive powers, and technically, it works independent of the three branches of government. It can't be fired by the president. It can't be made or created by the president. So it gets wonky. But if I were in the Fed's position, I would always say everything's possible. But anyone who's serious and understands history, and I'm sure Powell does, I knew Volcker did, Martin did. I don't think Yellen, Bernanke, or Powell really do. They know that this idea of can kicking debt, extending and pretending, and monetizing the US Treasury market by creating money out of thin air is not a magical solution. That is a fantasy. As Ernest Hemingway said, that buys temporary prosperity, but it leads to permanent ruin of inflation. And what we've enjoyed is the temporary prosperity, really since the 80s, of low interest rate policies. And then the Fed expanding its balance sheet and printing money whenever there was a hiccup in the markets, including the dot-com bubble or the great financial crisis of 2008. Every crisis, every dip could be bought with money created at the Fed. And they've tried to argue that that's not inflationary, but of course it is. When the M2 money supply has gone up 5x in the last 20 years, I've said that's like adding a bottle of water to a small glass of wine. You're diluting the power of your currency. And so the Fed knows that this is an unsustainable approach. And many FOMC heads in places like Kansas City or elsewhere have been more honest than in DC that this is unsustainable, that this was short term thinking at the expense of long term pain. Thomas Hernig has said that many times. This idea of doing QE or expanding the Fed's balance sheet like a thermostat or raising or lowering rates like a thermostat while your debt is exploding is a fantasy. It's a short-term stimulant, like it's like a Lance Armstrong effect. You get short-term glory, but it just takes one moment of disgrace when those steroids no longer work or when you're called out. And we really have been enjoying the steroid effect, the temporary prosperity of just having unlimited liquidity when needed. but we've ignored what it's causing. It's causing inflation, and it also is like a drug that you take too much of that eventually loses its effect, and then it no longer has the power to do anything for you, and all you have left is the hangover. Or the martini is no longer making you happy, it's actually making you physically sick. And not enough Bloody Marys can solve that. That's where we're at the Fed. Powell has to know that. He tried to fight inflation by raising interest rates, for example, 2022, 2023. That did not work. Why? Because Uncle Sam owes over 30 at the time owed over 35 trillion in debt. If Powell raises rates to fight inflation, he actually raises the bar tab for Uncle Sam. It makes Uncle Sam's bar tab too expensive. So he couldn't successfully do what Volcker did in the 80s because our debt level under Volcker was smaller than it is under Powell. So Powell was trapped. He couldn't raise rates to fight inflation. He failed. He lost the war on inflation. He just stopped talking about it. Like COVID, we just stopped talking about it. Look at Trump. He announced Liberation Day with the tariffs. We can applaud why that's a good idea or why that's a bad idea, but here's why it's not going to work. Because as soon as he made that announcement, markets went into a galvanic crisis. The VIX spiked. We had intraday trade moves of 10 to 12%. But the thing that no one noticed was the bond market tanked and yields started to rise because no one trusts the US Treasury in the backdrop of these tariffs. And there was no run to those US Treasuries. So that was another sign that regardless of what Powell wants to do or what Trump wants to do, they have 2 or 3 or 4 huge cannonballs tied to their ankles because our debt levels are so high that if any kind of crisis or any kind of policy, rising rates or announcing tariffs, causes distrust of our US Treasury, the IOU from Uncle Sam, and no one buys it, that means, again, those bond yields go up because there's no demand for bonds, and the cost of our own debt in Washington, D.C., becomes unpayable. And that's probably why Bessent probably walked into the White House the day after the tariffs were announced and said, look at the bond yields on the US 10-year. They're spiking to 4.5%. We got to stop something. So quickly, he made a pivot and took off those tariffs against the EU and other countries, left the ones in China and for China. What I'm saying is, like Powell, Trump is trapped by so much debt. Now, you can't blame the tariffs or even Powell exclusively on the reason things are breaking apart. What you can blame it on is generations and cycles and histories at the White House under red and blue parties and policymakers at the Fed, whether it was Yellen, Greenspan, Powell, or Bernanke, who've been under this fantasy that you can keep spending more than you produce, and you can call that growth. That's just what's called a current accounts deficit. That's just living on martini-like debt and pretending there's no hangover. And what we saw in the volatility in the markets is the first sign of a hangover, that queasy feeling before the real puking starts. And the only solution to keeping that market sustainable is to keep the market sustained by the Fed keeping interest rates down, which means they're going to at some point have to print more money to buy US Treasuries to keep rates and yields down, which means more currency debasement in the end. That's unavoidable. And that's inflationary endgame. And that creates social unrest and all the things we're seeing on the headlines for years. The only way we could see disinflation is if we have a recession, which we're on the border of right now, or the markets mean revert, lose 50 to 60 or 70%, which they will unless the Fed prints money. Those forces would be disinflationary or deflationary. But at the end, the government's response will be inflationary. It will be the bazooka money that they need to create to sustain the debt markets, in particular the credit markets, which is the US 10-year. So it's all tied together, Christian. It all comes back to this debt. And Powell, I've said, whether it's Powell or Trump, I've said cryptically, when you're looking at 37 trillion in public debt, when you're looking at over 100 trillion in combined household, corporate, and government debt, when we're looking at hundreds of trillions more in unfunded liabilities, when you're looking at that type of debt, no one, Santa Claus, Papa Smurf, a Nobel laureate, Mother Teresa, the Pope, no one can solve that debt crisis. There has to be what Schumpeter of the Austrian school called constructive destruction. Something has to break. There's going to be mess. You have to start over. And we're at that point now where we're still hoping a Powell or a Trump or Santa Claus or the Tooth Fairy is going to solve our debt crisis, or that we're going to grow our way out of this debt. You can't grow your way out of a debt crisis when your debt to GDP is 125%. Every economist from David Hume to today knows that when you cross the Rubicon of debt to GDP of over 100%, that's like trying to swim with a cannonball. Your growth slows by 30%. So it's a mathematical certainty, just like the Battle of Gettysburg or the Battle of Stalingrad or the Battle of Waterloo. At a certain point, when you have less troops, less ammo, you're going to lose. And you're going to lose the war, even if you win the battle. And so it's a mathematical certainty to me and many others that this debt crisis in the US cannot be fixed. So I have some sympathy for Powell or Trump, because whoever inherits this mess is just waiting for the music to stop and not enough chairs. And they'll either do smart or desperate things to fix it. But there's no one who can fix this right now. We're going to have some destruction in the markets. We're going to have to cut spending. We're going to have to increase our growth. We're going to have to reshore jobs. All the things that Trump says he wants to do, I understand that. But if he thinks he can get there without pain in the middle, that's a politician's mistake. That's impossible. And Besant and Trump have talked about short-term pain, long-term gain. These tariffs will bring jobs back to America. I'm all in favor of bringing jobs back to America for a lot of reasons. But that will not be short term, and it won't be minimal pain. That will be long term solution, and it'll be long term pain before we get there, because the world is going to go into a global cataclysm as these tariffs continue and as these debt levels start to crack. So although you can applaud reshoring, you can applaud cutting expenses at the Doge, and you can applaud finding fraud at USAID, all laudable, politically, optically smart things, there is no clean, easy solution to the debt crisis, Christian, and that's why we come right back to this debt crisis. It's math. You just do the numbers. We simply don't have enough GDP, enough income, enough liquidity naturally to cover the unnatural levels of debt that we have. And so to fill that delta, we will mouse click money at a central bank, and that will debase the currency, and that will make the man on the streets purchasing power for his $20, $5, $1 bill all the more weaker, which frankly everyone can feel without the CPI or the Bureau of Labor Statistics telling them that. They feel it every day.
Well, and I remember hearing you on another show. You mentioned about how in your, I believe it was your own hometown, people offering to, wash cars and such, and how
Yeah.
that really, resonated with you.
Hey, look, it's I come from the middle class, Middle West. I romanticize it, but there is something true about it. There's something true about small town America. Nothing wrong with big town America, but this is the America as they're the first to get drafted and the first to get shafted. In other words, when things break down, they're always the first ones volunteering or the first ones drafted for our wars, many of which were poorly thought out. But the patriots always show up first, and they're always the first to go. So that the first to go in. And are also, when the markets crash and they're not sophisticated, they're not living in Palm Beach or New York City or Wall Street, and their advisors have them in diversified stock bond portfolios. When markets crash, they're the first to get shafted because they're in passive set and forget portfolios. They're in pension funds, 401ks with no sophisticated advisors, no, I think, transparent, honest advice about risk. And they just trust. So they trust their government and they trust their advisors. And then every 15 or 20 years, there's a war or a market reversion and they get crushed. And instead of complaining and pointing fingers in my hometown, where I'm from, where I'm very proud of, as I said in that interview, my mom tells me about people that put signs in their front yard. They'll wash your car, or they'll do grocery shopping for you, or they'll come up with a way to build a fence or a deck. They'll come up with ways to help themselves. I find that incredibly endearing, and that's the best part of America. That's what Walt Whitman described as the heart of every country, is its middle class, right? What's really sad to me, though, is our government, left or right, and our central banks, and certainly our Wall Street, where I, like David Stockman, left my small town, went into Wall Street, like the sheep among the wolves. But the fact is that our government, our central bank policies, our monetary policies, our inflationary policies have absolutely crushed the middle class. The patriots, the ones who are the first to volunteer or get drafted, they're also the ones that are getting shafted. And I'm telling them, and I'm telling you, in my opinion, as a veteran of that small town and Wall Street, as someone who's seen the rigged game, you're getting shafted again. The narrative that your dollar is going to be safe is wrong. The narrative that we can solve a debt crisis with the External Revenue Service of tariffs is not honest. The narrative that we can get through this with short-term pain and long-term gain is not entirely honest. And the narrative that inflation is only at 3% is absolutely not honest. So the question is, don't become a nihilist or a cynic or hate government or hate America or hate the flag. The question is, think for yourself, be commonsensical, protect yourself if you can by recognizing that you're your dollar bill is losing value every second of the day. And if you can, I'm not saying to get rich. Don't speculate in Nvidia or Bitcoin. That's going to cause some frustration for some. Try to protect the money you have with a gram or an ounce of gold if you can. I always am very conscious, though, that again, from my hometown, there are people in the middle class who have no luxury to worry about whether they can buy a gram or an ounce of gold. Egon would say we can all afford some silver or some gold, but I recognize that for many Americans, they're just trying to get through the week or the month. And that's heartbreaking because I understand that. So even if you can't afford every solution, I think many people can afford something if they think carefully. But even if you can't, you can afford to get informed. You can afford to ask, I think, more sensible questions and hold your government and hold your media and hold your advisors more accountable for whatever excuse they give about the next extraneous event that causes markets to puke, or whatever story they tell, or whatever war they distract us with, whatever policy they say is for our best interests. Think for yourselves, think a little more deeply, understand the relationship between debt, central banks, interest rates, currencies. You don't have to go to business school or fancy school to do that. You can get informed. You can make your own decision what you want to do with that information. If you think Bitcoin or tech stocks are a better fight or a better way to fight that, that's entirely up to you. If you think precious metals make sense, I think there's a lot of support for that too. But at least get more informed than the mainstream media, which is owned by 5 corporations and tells you a narrative, just like the Fed and the White House, whoever's in power. It is a narrative that is not entirely honest. That's not anti-American to say, and it's not anti-American to question. It doesn't mean Matt Piepenburg has all the truth and I have all the answers. That's for each of us to discover on our own. You'll get there faster by listening to people like you interview, or reading books that are helpful to that. Having mentors like Egon von Greyerz or David Stockman or whoever, but find a way to educate yourself and get informed. You don't need an advanced degree from Princeton to do this. You need to trust your own instincts and listen to more than the legacy media. The problem is the online space is full of just as many crazies and quacks as there is offline. But, trust your own instincts. People can gravitate towards who makes sense to them. And I think that's the greatest challenge and the greatest reward, is to be informed rather than emotional or confused. Boring things like bond yields, boring things like the Fed budget, the balance sheet. When you hear propaganda that it's all this person's fault or that person's fault, think again. Again, I'm not anti-Trump. I'm an equal opportunist cynic when it comes to government. But for example, to blame China on our budget deficit or on our production problems or on our current accounts balance is really disingenuous narrative. There's a lot of reasons to distrust China. There's a lot of reasons to be concerned about China, and China has a lot of problems. But it's like Jeffrey Sachs said recently: if you have a credit card like the national government has and you overspend, that's nobody's fault but yourself. If your wife or son or daughter or husband goes off to a store with a credit card and maxes it out, and then you get the bill, you don't blame the store for that. You blame the person who spent. And if America's got a current account deficit of $2 trillion a year, that's not the fault of the BRICS or China or the rest of the world. That's the fault of America, the government spending more than it earns. To throw just great patriotic statements and bromides and all these out there and blaming the rest of the world for what is really an American problem, I think is disingenuous. That said, I'm really grateful for Trump to try to reshore jobs. But if he really wanted to reshore jobs, he should put a tax on all the American CEOs who've outsourced the labor from the Midwest, from Iowa, Michigan, and Ohio to China and Eastern Asia, because that's the real cause of the offshoring of American jobs. C-suites get cheaper labor overseas, and they fire 6 million Americans to build our American widgets in China. That should be an open discussion. Instead, those CEOs are campaign contributors to the left and right parties. The real problem with the globalization was our American CEOs. That needs to be discussed and debated more openly. Apple makes these beautiful iPhones. They're all made overseas. John Deere tractors that grow through Michigan and drove through all the cornfields that I played baseball outside of, they're made in Mexico. So do you punish China and Mexico for that? Or do you call the CEOs of those companies and say, hey, bring those jobs back, or we're going to tax you at 70% on your income? In other words, there are other ways to do this. And I think, again, that's just an example of a narrative that I don't think has been fully unpacked in the media or in politics. Doesn't mean I'm anti-Trump or pro something else. Whether you're left, right, or center, just ask deeper questions. Hold things accountable. become more informed. But again, way past tariffs, way past Doge, US aid, Elon Musk. Gosh knows we all agree that Biden was asleep at the wheel, not sharp as a tack. It's not about red or right. There's all kinds of reasons to complain, but get past all the politics and just look at US debt levels, US GDP, US tax receipts. The debt is so much higher than tax receipts and GDP that we have a real problem. And that gap is getting wider and wider with each year, which means that hangover is being postponed more and more. And that is the real problem. We can debate about transgender bathrooms. We can debate about racism, BLM versus MLK. We can debate whether schools are good, whether police are good or bad, left cities versus right cities. But all of that is important, but it's distraction from the fact that we are broke, that we have a credit crisis, a debt crisis, a currency crisis, and hence an inflation crisis. And that needs to be discussed more openly. And that shouldn't be partisan. That should be American. And the reason you're suffering, and many people are suffering, especially in the middle class, is their dollar just doesn't buy what it used to at all. And it's getting diluted as we speak. So that to me is criminal. That's the invisible tax of inflation. That comes from your own government spending. Uh, just like the Constitution warned us 250 years ago, it said in Article 1, Section 8 and 10, that the only money in America should be backed by gold and silver. We welched on that in 1971. And our founding fathers understood that 250 years ago, that if we didn't have sound money, human nature would step in. Politicians would be tempted and seduced to print money to create more opportunity, to create more good times, to create more election, more votes, more popularity. And that would be temporary, but the longer term effect would be the total debasement of our money. Because our founding fathers, however flawed they were, weren't stupid. And they saw history in the 1700s. They knew what was going on in other countries, other currencies, and in history, that you need sound money. So we violated that principle. So 250 years after our founding, here we are, late stage empire, broke, indebted, debasing our currency, and blaming everyone else but ourselves. That's my take on it, Christian. It's not easy to follow all those threads, but it really all comes back to debt. And I think if people understand that without a bias towards gold, silver, Bitcoin, Nvidia, tech, whatever, just understand debt, and you'll have a better understanding of where we're headed.
Yeah, I'm just amazed by how much just a I mean, obviously, there's a lot of things to know in life, but as it relates to finance, which I feel resonates with everybody,
Mm-hmm.
it's amazing how few people are even aware of this, and even people who are the average Joe might consider to be more or less sophisticated, if you will,
Mm-hmm. Mm-hmm.
they are mired in their inculcation of this or that. Working
Sure.
at big firms as an advisor, had lunch
Yeah.
with somebody recently. He's like, "There's no debasement going on. There's none of this," and I'm like, "Okay."
I mean, again, it's just quantum. There, opinions are wonderful. We all have opinions, but facts are stubborn. Facts are facts. Now, you can look at those facts and have different opinions, but you can't make up your own facts. You can have your own opinions. It is a fact that the purchasing power of the greenback, the U.S. dollar, the fiat dollar, has lost greater than 99% since we went off the gold standard when measured against gold. That's a fact. So that is debasement happening right in front of you. It is a fact that the scale we use to measure inflation in 2025 is completely different than the one we used under the Volcker era. And if we use the Volcker scale, we'd be at 13 to 15% inflation. That'd be more honest. That is a fact. Look it up. So again, it's like you can have different opinions, but to say there's no debasement, that's simply untrue. That's not even an opinion. That's just not true. If you're an advisor, then you're not telling the truth. You can tell your clients, I believe in tech this year, I believe in industrials this year, I believe in hard assets this year. That's an opinion. You have the right to that. But to say there's no debasement, that's inherently untrue. And so that I have a problem with, and again, most Americans, whether they're plumbers or brain surgeons, baseball coaches or school teachers or dental hygienists, most of them have families. Most of them have common sense. Most of them are good people. I believe that. And with your spouse or your partner, and you're sitting down at dinner, and you say we've got way too much debt and not enough income. Well, then if you're a normal family, you cut spending, you don't buy the second car, you don't take the vacation, and you look for better income. Most families do that. They don't blame anyone else. They just do it. Most smart companies, and I've had many clients who run good companies with very little debt because they understand that debt destroys. Just like David Hume says, debt destroys nations, it destroys companies, it destroys families. So even good companies will work out not over leveraging their balance sheet or not taking on more debt than income, not extending and pretending if they're honest with their shareholders. Many are not. And frankly, most good companies, which are a minority, and most families, which are a majority, have this common sense. The reality is our government is not acting like a common sense family or a common sense company. They're acting like a spoiled child with their dad's credit card and trying to get elected on other people's money or debasing their money without telling them. So you're frog boiling in inflation. You're frog boiling in debt as an American citizen. And the American politicians and central bankers are telling you it's not their fault. It's not. It is, because they're spending more than they're producing, and they're filling that gap with mouse click money, which is what our founding fathers warned against, foresaw, and is exactly what's happening now. And it's been happening since 2008 in particular, but even before then. And so it's just math, history, and debt. It's common sense. That's not left or right. That's not anti-American. That's understanding balance sheets, debt, and history. And again, we start out with the Dutch, the British, the Spanish, all empires rise and fall. The American of our forefathers is very different than it is today. It's not the end of America, but it's definitely not the America that we think in the next 10 years was like the last 10 years. That's not even being anti-American. We need this constructive destruction. We hopefully will take accountability for it. We hopefully will reshore jobs. We hopefully will have more honest politicians. That's good luck. But hopefully we learn from this. But the only way we're going to learn is if we're aware of what the underlying cancer really is. And the underlying cancer is generations of building our debt and outsourcing our labor, outsourcing the P and GDP overseas, and pretending that we could survive on solving a debt crisis with more debt and then paying for that with money we click out of nowhere at a central bank that isn't even a federal or a constitutional entity. That is fact. So you can have opinions on what you think of that. But I think Americans, left, right, or center, should ask those questions, whether you're a billionaire or whether you're a bricklayer. You should ask those questions, and you should know the answers, and then make your own decisions, and vote and think and act and write accordingly. I think that's just why Egon got into gold many years ago, why I got into gold, why our clients got into gold. We understood this. And we come from banking, we come from markets, but we also, most importantly, understand history. And that kind of way to end the discussion where we started. You've got to understand the history. You got to believe that you're living in it right now. It doesn't change tomorrow morning. It changes slowly and then all at once, very exponentially.
Well, Matthew, this has been not only a learned discussion for me, and I surmise for the audience as well. How can people learn more about you, your firm, and get in touch with you?
Yeah, we're at vongreyers.gold. That's a hard spelling for some, but we can also be found at goldswitzerland.com or vg.gold. But goldswitzerland.com is the URL that was always been there, and all the articles and interviews that Egon and I have, and that Ronnie Sturfel at Incrementum writes for us too, and all of that can be found there. It's a great website, not just for becoming a client of our company, but it's free access for everyone, because there's a lot of articles that you can educate yourself with. There's a whole page on why gold. You don't have to be a client to read that, to understand that. And more importantly, not just why gold, but how to own it. And we recommend not owning gold in ETF paper form for a lot of reasons. And we don't recommend storing gold in commercial banks because of their long history of failing that. So it's a little bit about why, a little bit about how, and a lot about history. And these articles go back for many, many years, so you can pick a theme. But all our writings and interviews are there, and it's a good free resource. I think it's something I go back to and read old articles from every now and then, just to come up with ideas. But yeah, goldswitzerland.com, and have a look at it. It's certainly a free resource. You don't have to be a client to enjoy that.
Well, thanks so much for being on, and looking forward to having you on in the near future.
Well, thanks for inviting me, Christian. It was a real pleasure.